All righty, folks. A very popular show where we come back from Mr. Dan Bird and we take a look back. And in episode number 2, we will, of course, talk about CPI, PPI, and retail sales. But in order to get to episode 2, we must look at where we've been, where we are, because, again, Friday was a closed day on the stock market. We did get a jobs report. So we did get a lot of information last week. And the market has yet to digest the jobs number, right? Because the stock market was closed. We had some future activity and whatnot. But Dan, where have we been? Where are we at? What's going on?
Well, first, happy Easter.
That's true. We are recording this on Easter. Happy Easter.
Yeah. Yeah. Interestingly, since the market was closed when the jobs number came out, usually you get an immediate reaction.
Correct.
And now the market's had a whole weekend to digest it.
Yeah.
So you usually get a reaction one way or the other, and then you'll get an opposite reaction the other way.
Yeah, exactly.
So now that the market's had some time to digest it, I think what we see on Monday will probably be the right reaction.
Yeah,
especially in anticipation of the CPI number.
Yeah, CPI is going to be a big number. We will save that for episode 2, but
yeah, I'll touch on it.
Yeah.
We'll look at the calendar. I'll touch on it there.
Okay,
but
there we go.
I'll share my. Oh, you got to let me share.
I knew I forgot to do something.
Mm-hmm.
There you go. Sorry about that.
No problem. Okay. Let's start with let me start with my newsletter. Just to kick things off. Happy Easter. I do a newsletter every Saturday and I share it with my friends and family and now folks on your channel as well. It's free. It's not meant to try to capture emails or anything like that. It's just really my process of researching the market, essentially.
Right. Mm-hmm.
And I put some little cartoons in there. I thought this one was funny. If you keep working until you're 85, you can afford to retire early.
Nice. Scary thought.
Right. And then I talked about TAS, Transportation as a Service, mm-hmm. which we'll talk about that in the second section as well. But that's something that's coming. It's going to fundamentally change the way we live.
I agree.
So that should be interesting. So if you want the newsletter, just send me an email to breakpointtrading@gmail.com, mm-hmm. and I'll send you last week's and add you to the list. This is where we are. So here we are today, right here. Non-farm payroll was on Friday. We got the CPI inflation report on the 12th. So that'll be on Wednesday.
Yep.
Very important report.
And yeah, you're underselling it. It's very, 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 very important. Yep.
Yeah. How many varies was that?
I don't remember, but probably a lot more. Yeah, something like that.
The interesting thing about this, so this comes from Stock Traders Almanac, which they actually go back 100 years, but this is back 50 years. The tendency of the market in the month of April.
Yeah, it's 70 years, but just between friends.
Yeah, 73 years right there. The dark lines are all years. The dotted lines are pre-election years, which is what we're in this year.
Yep.
Because typically whoever's in power wants to,
yep,
pad their position and make the economy look good. So oftentimes the market goes up in pre-election years like this.
Makes sense.
Interesting thing to note here, though, is you can see where we are right here, and this black line is the Russell 2000, but all of these lines basically bottom out for April on Monday.
Interesting.
Okay. And from Monday on, including after that CPI report, it trends higher.
Yeah, and this is something you first introduced to us last week when we looked at this report, basically saying it's why you might be bullish for the next 4 to 6 to 8 weeks is one of the many reasons why you are at least trading bullish, maybe not investing bullish, but trading bullish.
Yes, that's right. That's right. Okay. Yeah. And there's lots of reasons why. We'll get into some of that. Mm-hmm. So this was interesting. We'll see what happens next week. Good. We're going to talk about the jobs number, but this is a chart I found on the JOLTS number.
Yeah, it came in last week, sub 10 million. Yep.
Right. And it's trending down.
Oh, clearly. Yes.
So that's what the Fed has wanted to see. Now, pre-pandemic was down here, right? So still got a long way to go to get to pre-pandemic levels, but it is trending in the right direction as far as the Fed's concerned.
Yeah, I think most of the economic data last week was Fed friendly.
Yeah. Here's last week's calendar.
I love this. Yeah.
Yeah, this is very interesting. Manufacturing data was lower. It's below 50, so that's
contraction.
Contraction, yeah, which the Fed has wanted. There's the JOLTS number. I just showed you the graph, but again, it's below 10 million now. Non-farm payroll employment went down.
Job creation. Job creation.
Yeah, job creation. Non-manufacturing PMI is still above 50, but it's going lower.
Huge miss. A huge miss.
Yep, yeah, big miss there. Crude oil. Interestingly, it's actually less than what was forecast. So OPEC announced that they're going to cut production, and just across the board. And that's something maybe on a future episode, maybe next week even. I might put it in my newsletter, but I want to talk about what's going on with the BRICS.
Yes, lots of people would like to have that discussion. I think that's a great idea.
Let's wait till next week, because that could be a whole session conversation.
Agreed. Next week.
And then initial jobless claims down or up 228, up 28,000.
Yeah, they had some pretty significant revisions to the last 9 or 10 weeks, all what I would call negative, but actually positive, right? I think what happened last week is negative news actually is negative news, right? We lived in a world where it was really bad news is good news is bad news. I think now bad news is bad news. So we've kind of flipped that script. So
yeah, although if you look at the payroll, it went down slightly, but I mean, it basically met expectations.
Yeah, I thought, and again, I have the luxury of reading this a lot. It was a lot of 47,000 government jobs. So if you look at private sector, it was a 187, which was below. Also, wages were down.
Yeah.
Month on month and year on year. So,
wages is the important one that the Fed looks at.
Agreed. Yeah. 0.3 versus 0.4. Again, it wasn't, the last 5 months have been barn burner blowout on the other side. So again, I think the trend is in the Fed's favor. But yeah, Friday was kind of a wash.
Yeah. So the trend is in the Fed's favor, which is good. But it's still strong. The economy still is pretty strong.
You want to talk about what your thoughts are on May 3rd, or you want to save that for episode 2?
We will save it for episode 2. Cool. I'm going to show what the forecast is, but one thing I want to point out here, and I've said this many times on this channel, the unemployment rate went down 3.5%. A recession does not occur until the inverted yield curve goes back above 0. And then you've got then the clock starts. You've got roughly 4 to 6 months before the recession. But also the unemployment rate. Now, this one might be a lot closer to when the recession starts, when this materially starts going up. And I kind of put the 4% level as where that might occur.
Yeah, maybe. Yeah.
It actually went down.
It did.
I mean, I'm not, this isn't just me guessing. This isn't me opining.
No, this is pretty clear. Not only did
these are actual facts.
Not only did unemployment go down, but participation went up.
Right.
So it's a double strong job market. Yeah.
Yeah. So even though jobs is the last lagging indicator, you can't have a recession with jobs this strong.
No. Agreed. Yeah, and I think it's above 4%. It's probably more like 4.2 to 4.4, but we're in line. Yeah.
But if it gets to 4, then the trend is apparent.
Oh, the trend is agreed.
So here's the wild one.
Yeah, look at that.
Forecast 5.2. I mean, last week we were talking about 5.6.
We did, yeah.
Saying, well, I think it could get to 5.6, but they're forecasting 5.2. So what does that mean? What's going to happen? Does that mean if we get 5.2, the market blasts higher? But if we get 5.3, it sells off.
Yeah, we'll talk about that in episode 2, but
yeah, we'll discuss those in the next one.
Those are the right questions.
That is a very interesting forecast. So we'll talk about that in the next section. So let's take a look at, first we'll start with my trusty VIX.
Wow, it's down again.
Down again, lots of green. Look at that green, just keeps building here on the VIX.
Wow.
And it keeps dropping and dropping and dropping. I'm going to show you another chart that I showed a couple of weeks ago that's fascinating.
Look at that put call ratio. It's basically flatlining.
Put call ratio is flatlining. That's actually kind of a calm market,
right?
When that happens,
yep.
Usually when it spikes, that's when you start looking at a bottom. It's when it starts spiking a lot higher. Usually above this pink line right here, which is the 0.75 level. Okay. So if it spikes above that, then that's extreme levels for puts. But it's below it right now. And percent of stocks above their 50-day moving average.
Wow, 200.
Pretty average. I mean, it's not too high, it's not too low. I mean, this is we are in a Goldilocks market right now. The jobs number came in. I call it a Goldilocks number.
Yeah, I think it's fair. Yeah.
All of this is Goldilocks right here. Look at
what about the 10-year treasury I just saw? Yeah, there it is.
Yeah, look at that.
Yeah, I think it spiked yield on Friday. Yeah, it spiked on Friday just in the futures, but yeah, we'll see.
Yeah, it did spike with the jobs number. Yeah. But still, I mean, it's pretty low.
Yeah.
In my newsletter, did you get a chance to read it last week?
No, I did not read this one.
I put this article right here. The link to the article. Inflation is about to plummet. Wall Street firm says. This is Bank of America. All right. And here's an excerpt. B of A anticipates 10-year treasury yields at 3.25% by the end of 2023.
Wow.
And then I said, look at my chart. It's already at 3.28.
Yeah.
So not much of a stretch for B of A.
Yeah, they really went out on a limb, did they?
Right. Yeah, it spiked to 3.4 after the jobs report.
Yeah, that's funny.
But I thought this it was interesting that there's articles like this coming out now, and this is something I've been saying for months.
You have.
And now Bank of America is starting to say it too.
Yeah, one thing I want to give you credit for is you've been a little early on inflation rolling over, but you have been very staunch in that, and you're looking really good. You're looking really good today. So kudos to you.
Yeah, we'll see what happens, but
Wednesday's still 3 days away, so let's.
Well, yeah, Wednesday's still coming.
Yeah, exactly.
I mean, we could. What if we blow out that 5 point? We'll talk about that in the next.
We'll talk in the next episode. I don't want to get ahead. So let's.
All right. So this VIX is a shorter term. This goes back 6 months, roughly 6 or 7 months. But you can see it's definitely trending lower. If it gets below 16, then you never have a bear market below 16. And right now it's at 18.4. So that's a short-term look. This is a long-term look. So this one here goes back 20 years. So this is the VIX back 20 years. And you can see where here's the 2008 crash right there. This is COVID right here. And you remember my secular bull, secular bear thesis that I've talked about. So I put those in right here. Here's the secular bear, 2013, when we broke out of this high right here. And here's the secular bull that I've been saying that we are still in.
Yep.
And then inside of this secular bull, there are cyclical bears.
Of course.
And this particular cyclical bear is still actually going on. So there's no right-hand edge to this yet. And it will continue until we break out of this high up here.
Yep.
48.8. Okay. Now the last one, this one was fairly extended here in 2018, but it wasn't a deep one. Right. COVID was deep. And there was a brief one here in 2015, 16 as well. This one here has been a very long bear market. but it is still technically a cyclical bear market.
Yeah, it's been fun for me to watch because we do this every week just to see it kind of just gyrating around what 3,900 to 4,200 for quite a while.
Yeah, and I'll show that in a second. I'll show that chart in a second. That's very key levels that we're at. Also look at the percentage of stocks below their 50-day moving average. This is something I look for to try to identify a bottom. So here's this cyclical bear right here. It went below the 10%. So think about that. 10% on the S&P 500 is 50 stocks.
Right.
This one is just barely below 10%. So there's maybe 45 stocks. This one here went all the way down to 2%. Wow. There were only 10 stocks out of 500 that were above their 50-day moving average. And then this recent one here in October dipped below it as well. So these are indications of bottoms when that happens. The one below that, the red one, is the 200-day moving average. It's harder for it to get that low.
Sure, yeah.
But it did here in COVID. It barely touched it here in October. But you can see it rarely ever gets that low. This is 15%.
Okay.
Below its 200-day. This is the 2008 market right here.
I remember that time frame.
Yeah, it stayed there for quite a long time.
Yeah, it did.
All right, so we touched it here, but we haven't really come close to it since then.
Right.
And then the 10-year, again, going back 20 years. That's the 3.5%, this pink line right here. You can see that's cutting right across the middle.
Yep. Okay.
So again, all signs that we may be still heading higher. Here's a close-in view of the S&P. So this is where we are Friday. You can see, and I commented in the newsletter that the two things that I look for, if we are in a bull market, whenever there's a retracement, I look for this PPO line getting above zero. So resetting above zero. So it did right here, which is right in here. And then a retracement should not go below the 21-day moving average, which is the blue line right here.
Okay.
So this one retraced for 2 days. It looked like it was going to continue going down, but we had a nice bounce on Thursday.
Okay.
I think because of the jobs market or jobs number, I think this is going to continue going higher.
Yeah, you could.
And look at the accumulation distribution.
Yeah, that's that's Wall Street putting money to work or building positions.
Wall Street agrees with me.
Yes.
So here's the other one that I showed. This is the very long term. This is 3-year. And I said, this red area in through here, the shaded area, that's the congestion.
4,200. Yep.
4,100 to 4,300. Yep. 4,200 right in the middle, which happens to be the 23.6 Fibonacci level. It's that orange line right at 4,200. So we've got to get through this area right here if we have any hope at all of getting back to the highs up here. And it could be a bumpy ride through here. So I'm expecting, we'll see what happens in the next session when we talk about the CPI. We'll see what happens here. It'll be very interesting to watch.
Okay. All
right. And then this one is also really interesting. I showed this a couple of weeks ago, right after the banking crisis.
Yep.
And if you remember, this blue line, this blue vertical line is the banking crisis right here. All right, that's the Silicon Valley Bank.
Yep,
right?
SVB.
SVB right here. And I said at the time that the VIX and the 10-year were correlated on opposite sides. But as soon as that happened, they became uncorrelated. In other words, the VIX spiked higher, which means fear, but the 10-year spiked lower, which means a flight to safety.
Right.
Yep. Right. So we talked about this the last time, and that went on for a few days, about a week or so, maybe a little more than a week.
Okay.
Until look what's happened now.
Yeah, I think it's wild to look at it.
The whole market is like, yeah, okay, that's over. We're done with that one.
Yep, that was a big nothing burger.
Right. On to the next.
Yeah.
VIX, VIX went from, VIX is on the left side over here. So 29, almost 30 down to 18. And both of them now are just kind of bouncing along together.
Yeah, you're right.
Near the bottom. So that's an indication of a very calm market. Or another way you could look at it as a market that's wound up like a spring.
Okay.
Getting ready to do something big.
Hmm.
And that something big may come on Wednesday.
Yeah, it could.
So that's pretty much what I have. I showed this one. This was kind of an esoteric chart that I showed, the McClellan oscillator.
Right.
And anytime it gets above the green one here, it goes up. It started to pull back with that pullback the last couple of days last week until Thursday.
Right.
But you can see here that the S&P actually this is the NASDAQ 100. Mm-hmm. NASDAQ actually bounced higher right there on Thursday. So we'll see if this starts to take off again. But this, usually if it's above this line, that's positive. The market continues higher.
Okay. So
we'll see what happens.
All right. Well, do me a favor, show your newsletter, and we will get into episode number 2.
Yeah, that'll be the fun one. If you're interested, just send me an email to breakpointtrading@gmail.com, and I'll put you on the list. I'll send you last week's newsletter, and then you'll get all of them from here on out until you tell me to take you off.
There you go. All righty, folks. Episode number 2, we're talking about CPI, what we expect, what could happen. It's going to be fun. Stay tuned.